Last week I had put a video up looking at EV versus ICE, and at the very end I gave sort of a very quick back of the envelope projection for Tesla on where I think it was going in terms of margins and multiples and price. And some good objections were raised in the comment section. Well, what about this, or what about that, or what about this? And I didn't really go into a lot of detail in that video, doing a lot of support for the numbers that I got to, or how I got to them, or what my reasoning was. So I read all the objections, I read all the pushback, and I grouped it into a number of categories. The biggest one was the growth rates, that I'm underestimating their growth rate. The baseline that is out there in almost every projection is that they're going to continue to grow at 50% a year for the next 8 years, which is an unrealistic forecast. If we look at ARC's projection, it's more aggressive for longer. Linear projections. If you take UBS's forecast, for example, and you plot their revenues, you'll notice it's a straight line. That if you take the years and you plot what the revenue forecast is, it looks like this. And if you plot their gross profit, it looks like this. It's just a straight line. It's just a linear projection. That kind of growth rate for that kind of period of time with the competition that's coming in is unrealistic. That it should look something like this over time. That is normal, but no projection is non-linear. Almost every projection you see is linear. So we'll talk about growth rates, and I'll defend the growth rates. And in doing that, I'm going to specifically look at competition and the supply channel. And for the supply channel, we have to look at battery material and chips. And I'll be relying very heavily on industry, different industry organizations that do research, and different companies within those particular industries and what they have to say. The next big point of contention were the margins, that they're not going to have shrinking margins. They're the Apple of vehicles. That gets compared to Apple a lot. Tesla is not Apple. There is only one iTunes. There is only one App Store. There is only one iOS. There is only one, but there are many electric vehicles. There's many levels of autonomous software already out in the market. Some companies with autonomous software far superior to Tesla's. So Tesla is not the Apple of automobiles. One person in the comment section said Tesla is more like Mercedes than Apple, and I agree with that. I think that's a good statement to make. We'll see what that means. So we're going to look at the industry structure of how this industry is evolving. You can choose your own strategy. You can choose your own features on which you want to differentiate yourself from the competition, but you don't get to choose the industry structure in which you compete. That industry structure is defined by the level of competition in that industry, by the number of suppliers and the power those suppliers have. So we're going to look at what the current industry structure is and what it's going to evolve to. You can't escape industry structure. It's like gravity. It's simply going to happen, and the industry structure sets the attractiveness of the industry in terms of where does the profitability in that industry lie, depending on where the power lies. So we'll look at that. Number 1 and 2, make the multiple argument, because that was another point of pushback. Oh, your growth rates are too low. They're going to keep their margins and they deserve a higher multiple because they're a tech company. Well, we'll find out if they're a tech company or not. Then we'll look at their financial statements, look at their earnings per share. There is a big difference between basic versus diluted, and we'll compare the spread between that with other automakers. And then they're a tech company. Okay, well, then we'll compare it with other tech companies. How's that? We're going to look at their sources of revenue, because one of them is going away. We're going to look at their upcoming expenses because right now they don't incur an expense for a certain category of expenses that they are going to have to incur. They're just absent at this point in time. And we're going to look at something with their revenue recognition. And it's important to look at this because whenever you see somebody doing something, you can say, well, they're doing it because of this. I think the simplest rule is follow the money. Can you tie money to that action? If you can, that is the biggest motivator there is. If you can't, then okay, then there's something else. Then we're going to look at their technology and their engineering because, heck, they're a tech company, right? And they're way ahead and full self-driving is coming. So we'll look at the full self-driving and autopilot. And there is a great research paper out there for sale for $3,600. I didn't buy it for $3,600. But there is a small citation from it that we'll use. I'll show you the site. Well, first of all, if you look in the description box, you're going to see links to a whole bunch of things. Every source I use is in the description box that you can then go to it yourself and see what's there. This research report is there. It's $3,650. They're selling it. So when you're selling something for that price, you can't have an axe to grind. If you have an axe to grind, if it was paid research to really make one company look bad, it would be available for free. That would be the point of it. There's no point in putting out PR stuff if you're not going to give it away. When we get to it, we'll jump into it a bit more. Before I begin, let me say something here, right off the top. Tesla's unit sales will continue to grow. I am not saying it's going away. They'll continue to grow. In fact, I'll show a forecast later, and we'll compare it with Bloomberg's forecast of unit sales. I'll compare my unit sales and growth with their unit sales and growth. They'll continue to sell more units. Absolutely. I'm not saying Tesla's a crappy car. I'm not saying it's the best car out there, but I'm not saying it's a crappy car. So in 8 years, Tesla's going to be a player. Tesla's going to be around. It's not going away. Its earnings per share over time will increase as well. I don't think that this is the best that we'll see in earnings per share. I'm pretty sure it's going to increase. My argument is their growth rates are not going to be what most forecasts have their growth rates at. Their margins are going to shrink. That is just the nature of competition and the industry structure they're headed to. No company in the history of the world has escaped the inertia of the industry that they're in. And because of that, they don't deserve the multiple they currently have. So that multiple will come in line because the growth rates and the margins will come in line while they're increasing their volumes, while they're increasing their earnings per share. So I'm not calling an end to Tesla. I'm not saying it's headed towards bankruptcy. I'm not saying it's going to disappear in 4 or 5 years and that'll be the end of it. They'll be a significant player with significant volume, just like every other car company, and they'll have a valuation just like every other car company. Okay, let's begin. We'll start with lithium. I had laid out this argument in the main video that there is a looming supply crisis coming. 25, 26, this industry is going to hit a wall. Here is lithium mine production worldwide from 2010. Look what happened here. Look at that huge jump up here, and it's expected to go even higher. Now, I should clear things up here. This is lithium mine production. You might see numbers of 500,000. You might say, hang on, I saw 500,000, not 100,000. This is lithium. This is either lithium carbonate or lithium hydroxide. So if you take lithium and you divide it by 0.19, you will get the equivalent amount of lithium carbonate. Lithium is used to create lithium carbonate, which then goes into the battery. So, but you still need the lithium. Batteries are expected to account for 95% of lithium demand by 2030. Here it is right here. Which means from 2020 to 2025, the increase in demand is 25% a year. From 2015 to 2020, it was 17% a year, and they anticipate it'll be 25% a year. I want you to remember this number here, 25%, because we're going to look at a forecast for growth in supply. Aggressive electric vehicle adoption scenario, 26%. This is just a base case scenario, and this is if you get really aggressive. Global metals and mining capex, and this is where we're sitting. Total capex required 160 billion. Look at where we are here for 2016, 17, 18, 19. To get to the targets that you want to get to, what this is saying is that you needed 160 billion per year to prevent raw material constraints. Well, what is this called? Underinvestment. What are we seeing in the oil industry now when you have years of underinvestment? You're seeing a very tight market, and look at prices. Look at where they are. And they're not coming down anytime soon, because without investment, you have nothing to create any increase in future supply. What are you seeing in the U.S. housing market? Now, after years of underinvestment, record high prices, record low inventories, that with interest rates going up, you're only going to create less investment. So this lack of investment it basically has sown the seeds of the future supply constraint. Climate change, investment in mining needs to nearly double to achieve net zero. This is from Bank of America. Okay, so on the last screen I said remember that percentage, 25% growth in demand from 2020 to 2030. Here is lithium production expected to expand by 20% a year from 2020 to 2030. Lithium production expected to expand 20% a year. Lithium demand expected to grow 25% a year. So you can see that we're going to hit a wall at some point. And here it breaks it down by region of where it's going to come from. Lithium recycling is still small scale, but could reach 6% of announced supply by 2030. So recycling, because that has been raised in the comment box as well, is that you're not going to hit this wall because of the recycling. Well, it's not. If we go to 2025 here, it's going to be just a tiny amount. And even in 2030, it's going to be 6%. So you have lithium production expanding by 20% a year. You have demand increasing by 25% a year. And if recycling works out well, it could make the difference by 2030. But again, if it works out well, that's a big question mark. The point that I'm going to get to is that by 2025, 2026, we're going to hit a wall, a significant wall in availability of lithium. And unless battery chemistries change significantly during that period of time where you can move away from lithium, this whole industry is going to hit a wall. It's not just lithium that's going to be in short supply or a tight market or have high cost for an extended period of time. Here are minerals used in electric cars compared to conventional cars, and this is the amount of kilograms per vehicle. Conventional car versus the electric car, and here's the legend of the type of vehicles that we're looking at here. And over here, this is minerals used in clean energy technologies compared to other power generation sources. Here's coal and natural gas down here. Here's solar, onshore wind and offshore wind in what is required. I haven't even talked about this one here, which is graphite. 80% of world supply of processed graphite is out of China right now. This is lithium in here. It may look small, but it's lithium, not lithium hydroxide or lithium carbonate. You'd multiply that by 5 to get the quantity of lithium carbonate that you need. That's just the lithium itself. So it is in more places than just lithium that are going to be supply constrained. 2 screens ago, Bank of America had the headline that world mining production needs to double. So think of all the mines in the world, now double them, and understand that the lead time just to be able to cut ground on a mine is 4 to 6 years. You have to have your feasibility studies. You have to have the geologists go in and first of all figure out, is there anything here? Then you have to have your permitting. You need your water rights. Then you got to build your mine. You got to build your infrastructure. I mean, you're anywhere from 6 to 20 years away from building out that kind of investment. Just look at copper here. Look at the sheer amount of copper that's needed if you are going to have these big wholesale moves to electric cars and, okay, get rid of this, and we're going all wind and solar. It's going to get very expensive. You're going to have elevated energy prices for years. Now, throughout this video, I'm going to try to anticipate all the yeah-butters. And these are people that, you know, when you're talking to them and you're stating your case, they don't really hear you. They listen to you and then answer with, yeah, but, yeah, but, yeah, but. So, yeah, but Tesla's taking supply off the market after I say all of that, because I saw that in the comment section of the last video. So is everyone. Everyone's taking supply off the market. Automakers partner with miners as electric cars rely on raw materials for batteries. Stellantis locks in lithium supply agreement to secure EV battery materials. General Motors strikes a deal to source lithium. BMW signs $335 million lithium supply. Ford inks Argentina lithium supply. Volkswagen secures lithium supply. Global car makers race to lock in lithium for electric vehicles. China, Japan lead the dash for resource deals to capture market for powering autos of the future. I could have gone on for about 3 or 4 more screens with all the headlines and all the names of all the companies. There's so many car companies in the world now. All the names of all the companies and all the lithium deals that they've secured, all the deals for all the different minerals that they needed, and all the sources. You just have to Google it, and there is pages upon pages of different car companies securing a long-term supply. General Motors with Glencore, 5 years for cobalt, and on and on and on it goes. So Tesla's taking supply off the market. So is everyone. Let's go to the next layer of yeah buts. Yeah, but Tesla's going to integrate backwards into lithium mining. I've seen that comment as well. So this is from September 23rd, 2020. Tesla bets on mining with Nevada lithium claim. To start, Tesla has bought the rights to a lithium deposit in Nevada. There, the company plans to pioneer a new way of sustainable lithium mining. Imagine that. No experience in the lithium industry. They got a new way of sustainable lithium mining. In the presentation, Musk said Tesla will be using sodium chloride and water. That's where it begins and ends. Water to extract lithium from the ground. No other lithium mining company has ever thought of doing this. They've come along with no experience whatsoever, and this is what they're going to do, right? The process should significantly reduce lithium processing costs and eliminate wastewater. Notice it's saying eliminate wastewater. It's not saying reduce water, just eliminate wastewater. Approximately 2.2 million liters of water is needed to produce 1 ton of lithium. You want to get this done, you need water rights. In Nevada, good luck with that. Have you seen Lake Mead? One of the richest deposits in Nevada, if you head north, is in Thacker Pass. But you got to get water rights. So it's gone nowhere. Not only that, 2 Native American groups claim that it is sacred land and you can't touch it. Environmentalists point out that there are 3 or 4 animal species there that you can't find anywhere else in America, so you can't touch it. And the farmers in the region say, you can't have my water rights. No way, not a chance in hell can you have my water rights. So there it sits. Oh, you can find lithium in Nevada. It's probably the most lithium-rich place in the U.S. It's there in the ground. You can take it out if you can find water, because you're gonna need water. Let's fast forward. This is a tweet that was put out on April 8th, 2022. Notice that this is September 3rd, 2020. This is April 8th, 2022, showing the price of lithium. Look at the price just going up per ton. 2012 it was $44.50. Now it's $78,000. Elon Musk replied, price of lithium has gone to insane levels. Tesla might actually have to get into the mining and refining directly at scale unless costs improve. Which then, a couple days later, spurred a headline. Tesla might now get into lithium mining business due to insane price surge, even though it's already supposed to be in it. Tesla's Battery Day event in 2020, the automaker announced that it's getting into the mining business, starting with buying lithium claims on 10,000 acres in Nevada. However, almost 2 years later, Tesla has yet to do anything with this claim or a new lithium mining technology announced at the same event. They did file a patent for an extraction process, but that patent, within that, it does not avoid the water issue. You got to get water rights. In Nevada, I want you to think that through. Think about the Colorado River, what's going on there. Think about Lake Mead, what's going on there. Nevada's facing a looming water crisis, and you got to get water rights. Lots of water, 2.2 million liters for every ton that you produce. This process is not going to reduce the amount of water needed. It's only going to reduce the amount of water waste by, when I say waste, typically how it's done now is you bring up from the ground the briny substance of which all the minerals are in it. Sometimes that brine is found naturally, and you're just going to bring it up to the surface, and you're going to put it in big pools, and then you're going to let the water evaporate, and what's left over are all the minerals. Rather than use open pit mining, what he's suggesting is let's just make the brine. Let's just pump salt and water into the ground, and it'll make this brine that we pull up from the ground. And by reducing water waste, what they're saying is that we have a process that rather than putting it in big pools and letting it evaporate, we can extract the minerals from the water directly. You still need water. You still need water in Nevada. I'm anticipating another yeah but here. Yeah, but Goldman Sachs says no supply issue going forward. And they did release a note on that on May 29th, 2022. The battery metals bull market has peaked, and they anticipate that prices will now come down because of a bunch of supply coming to the market. But in this same report at the very end, they write this: still, prices could soar again after 2024. The phase of oversupply will ultimately sow the seeds of the battery material supercycle over the second half of this decade. Then the demand surge will more sustainably overcome current supply growth. Benchmark Mineral Intelligence issued a response to this in response to a Goldman Sachs research note. They outlined 5 reasons why they think that Goldman Sachs is wrong. And I'm not going to put the article on the screen. It is in the description box. The link is in the description box, but I'll give you a highlight of the 5 reasons. Number 1, Goldman Sachs is relying on the growth of lithium supply in China. And they push back saying you can't count on that meeting the market. It's low quality and it's low yield. Goldman sees the most significant new lithium supplies coming from China, where companies have invested in new hard rock and brine projects. Right now, those are the 2 big methods for bringing lithium to the market. Australia is hard rock, which means it's traditional mining, whereas Argentina and the Salton Sea are brine projects. You drill into the ground, you hit this big pocket of briny water, you pull it up, and within it is the lithium itself, and you put it in these evaporating pools and you let the water evaporate, and then you're left with tons of lithium. Okay, so have invested in new hard rock and brine projects. However, Benchmark points out known domestic Chinese spodumene and other hard rock resources are low quality. A key reason why there has been an increasing reliance by Chinese converters on Australia for supply instead. Chinese brine resources are also low quality and have always struggled to produce meaningful volumes of lithium into the market, let alone of battery grade quality. Their second point, capacity does not equal supply. Just because you can find lithium doesn't mean you can get it out of the ground. Nevada being a case in point. Thacker Pass is in the north of Nevada. You're not getting it out of the ground anytime soon. In fact, other than existing mining facilities that already own water rights, you're not getting water rights in Nevada. Let's see, building capacity in the lithium market does not equal supply, particularly in China, where companies often need to separate designed capacity from effective capacity. Design capacity is saying, listen, there's 20 tons of stuff here that we can get it. Effective capacity is actually being able to get those 20 tons in reality. Sometimes what works on the drawing board doesn't transfer to the real world that well. Of that capacity, recovery rates apply. The rock you dig out of the ground will not all make it into the car. So from the chief executive of Benchmark Minerals, building upstream of the EV battery supply chain takes time and rarely goes to plan. Number 3, new lithium supply comes at a higher cost base. As demand for lithium grows, deposits with unconventional mineralogy, lower grades and higher strip ratios will be developed. But at the same time, the advent of new, often smaller and inexperienced converters with unintegrated feedstock sources will mean that the cost of conversion increases and recovery rates stagnate. Number 4, contract pricing is important as the market balances. And they point out, and this is the business that they're in, by the way, they point out that because they track it, the volume of lithium under contract and spot prices, Benchmark tracks the volume of lithium under contract and spot prices and forecasts prices accordingly. A large portion of the market is under long-term fixed price contracts, and an equally significant portion is under contract with variable prices. These must be taken into account when balancing global prices in the current market, but also forecasting the next 2 to 3 years. And 5, understanding how lithium chemical capacity is used is crucial. A lot of lithium chemical capacity is being used to reprocess material that does not meet downstream specifications. This eats up existing capacity and merely represents lower efficiency production rather than the introduction of new lithium units to the market. So that link is in the description box below. There are 2 links to Benchmark Mineral Intelligence. So I put them both down. One I didn't cite from it all, but it shows the growth in prices and has a discussion about that. The big difference between Goldman Sachs and Benchmark Mineral Intelligence is the near term, not the long term. They're both in agreement down here. They just disagree that over the next 2 years you're going to see pricing come down. We'll move into semiconductors now and look at what the problem there is, especially related to EV. But one last point on the looming supply crisis in materials. Graphite, we haven't even talked about graphite, but that's going to be a problem. Lithium is the big one right now. China may become a player in that. It may not. Nobody really knows at this point in time. But if the industry is going to hit a wall, China is not going to disadvantage its own domestic producers in favor of a foreign producer in their country with no Chinese partner. The Chinese Communist Party is not going to say to its own domestic producers, sorry, you just sit there, we're going to keep supplying this American company over here. When you have growing tensions between the U.S. and China, with the U.S. Blatantly saying openly, we cannot let China dominate the supply of minerals for battery. When you have the U.S. saying that we will intervene militarily if China moves on Taiwan. And just the other day, I think it was yesterday, China came out and backed Russia, saying that Russia was justified in doing what it did, and they support Russia. So you have these growing tensions. China let Tesla into the country without a partner, not because they really love Tesla and they really love Elon Musk. They don't do things without a reason. The reason they did it is because they didn't have a supply channel. Their existing car manufacturers that were moving into EV didn't really have an existing supply channel for EV. They knew if they brought Tesla in or they let Tesla set up in Shanghai, that in doing that, the whole supply channel would also be created, which benefits everyone else, and we'll see how much everyone benefited from that. Tesla's usefulness to China is almost near an end. And when its usefulness is done, it's not going to be a friend. It's going to be a foreign American company on their soil. Again, the Chinese Communist Party will not disadvantage its own domestic producers in favor of Tesla. It won't do that. That's a conflict waiting to happen, and that's something I don't see priced in or even thought about at this point in time. That's a conflict waiting to happen. Let's move on to semiconductors. From Reuters, automakers, chip firms differ on when semiconductor shortage will abate. You listen to the car companies are saying the second half of 2022. They were saying this last year, early 2022. Then it became mid 2022. Now it's the later part of 2022. Some saying early 23. Intel CEO now expects the chip shortage to last into 2024. And you think, wow, the guy's just talking up his own book. Expects the semiconductor industry to suffer supply shortages until 2024. The CEO told CNBC the extended timeline for the chip crunch is now due to a lack of manufacturing equipment. So, of course, I got to dig deep on this. I read that and I think, well, I don't know who to believe now. Is GM and Ford right saying latter of this year, or is Intel right? Both of them are talking up their books, I think. GM and Ford want to tell investors that, we'll be great at the end of the year, stay on board, and Intel is probably saying, hey, stay invested because the best years are in front of us, because with this chip shortage, prices have never been higher. U.S. will miss electric vehicle targets without big investments in semiconductor manufacturing, the Commerce Secretary warns. Electric cars require 2,000 chips each. It's a range. It's 1,500 to 3,000. Some are as low as 1,400. In the amount of chips they need, but compared to ICE is anywhere from 300 to 1,000. So if you're making this giant move over to EV, not only are you going to strain the minerals market in terms of copper, graphite, lithium, cobalt, nickel. I didn't even mention cobalt and nickel on the previous screens because the argument can be made just with lithium. But what about these chips? Now, there's a problem with these types of chips. So to understand the chip shortage, we do have to do a little bit of a seminar here on chip manufacturing. There is what is called leading edge and trailing edge semiconductor facilities. New capacity typically adds to the leading edge, so that when a new chip design or a new type of chip is being made, usually the thinner, smaller chips, a new facility is built, new equipment is built for the leading edge, and it runs and starts producing chips. Well, over time, leading edge eventually becomes trailing edge, so existing capacity migrates to here. There is a cutoff between the size of the chips. New capacity, the leading edge is 20 nanometers or less, and as you go less, the price dramatically increases as the size drops. Existing capacity, trailing edge, is anywhere from 28 to 65 nanometers. Well, it actually gets all the way up to 300, but autos hang out in this area right here, 28 to 65. Makes up 40% of the demand for these particular chips. These are low cost. Some of them are $2 to $3 a chip. That's about it. But you don't build trailing edge facilities. You build leading edge facilities, and leading edge facilities eventually become trailing edge facilities. This is history. So it's not as if there are new trailing edge facilities being built. They are built over here. These for this chip size, there's about an 18-month backlog right now, and these facilities are running at 95% capacity. Because again, you don't invest in trailing edge technology, you invest in leading edge technology. These are older fabs. The equipment makers focus on leading edge. So if you're an equipment maker for a semiconductor firm, you're focusing on leading edge equipment, not trailing edge equipment. Are you starting to see the particular problem? The automakers and EV vehicles need this. Investment doesn't go into trailing edge, it goes into leading edge. There's already an 18-month backlog that even if orders, the phone stopped ringing and the website stopped clicking and everything stopped, it would still take 18 months. And they're running 95% capacity utilization. There's no room at the inn anymore. And since they're older fabs which require older equipment to increase capacity, you got to find older equipment. But that's where investment, the kind of waking up and seeing that, whoa, this kind of demand here, we're going to have to put some investment in this trailing edge technology. So trailing edge fabs are coming. Taiwan Semiconductor announced it. Samsung announced something. China with SMIC. Foxconn setting up in India. And the U.S. CHIPS Act put aside $2 billion for what they call mature technology nodes. So great, you're going to build these facilities that focus on the 28 to 65 nanometer range. You're going to need equipment. Well, the equipment makers say, well, we got to break out the old blueprints and start making that. We haven't made that for how many years? We're going to have to start making that again. Lead time to get all this done is 1 to 2 years, which would, if you're 2 years in, you got an 18-month backlog, which is why I say 2 years. That puts you to 2024. Looks like Intel was right on that. The other problem with this, these chips here, anywhere from $3 to $4 depending on what you're buying. Reason is most of the investment was captured in the price of the chip when it was leading edge, when it was $1,200 or $1,500 or $900. So most of the investment had been captured in there. So this price here, you're getting out of just almost no recovery of investment required. Well, once you start investing in the trailing edge fab, these chips now have to recover all of the investment cost. They're not going to be $3 to $4. So just to finish up from the previous screen and tie those two things together, this new chip supply that will be coming onto the market, the trailing edge chip supply, is going to have to recover the investment cost. They're not going to be $3 to $4. We already saw that electric cars require anywhere from 1,500 to 3,000 chips versus ICE, which is 300 to 1,000. And the more technology you put in that car, autonomous driving, entertainment systems, etc., you're going to need more chips. So if you're going from $3 to $4 per chip and they have to recover that investment, you might be going as high as $10 to $15 per chip to get that done. So take 2,000 multiplied by $3, you get $6,000 in chips. Now take that 2,000 and multiply it by $15, you get $30,000 in chips. $6,000 to $30,000. That's going to be a problem. The cost of electric vehicles is going to go up significantly because those chips aren't going to be $3, $4 anymore, or you're going to have to significantly reduce the amount of chips that you need in a vehicle to get it down significantly, because you can't put $30,000 of chips in a vehicle, overlay it with a $15,000 battery, and be at 45,000 before you even build the car. You're never going to get mass market adoption. But that's where we are, and that's what we're thinking of doing. Or at least that's the reality on the ground. Let's look at competition now. We've talked about the supply in terms of battery material and semiconductors, and the case is there that these are going to be tight markets for a very long time, and it's only going to raise the cost of the vehicle that you're making. Speaking of raising the cost of the vehicle, as I narrate this video on Thursday, June the 16th at 6:57 a.m., in my news feed when I got up, and I'm usually up around 4:35 when I got up, saw that Tesla had raised its prices on all its vehicles by as much as anywhere from $2,500 to $6,000. They've been raising their prices for the last year, almost on a monthly basis. They've had a price increase. They haven't had one, I think, for 5 or 6 weeks, and they just did it again because the backlog, when you order a Tesla now, you're not going to get it for 12 months. So they have to anticipate, well, in 12 months, what's the price going to be? They can see it. They can see that these are all tight markets for a long period of time, and those are going to be what the price, that's their best guess as to what the price will be in a year. So if you click on buy now, you're not buying now, you're buying in a year, and that's what the price is going to be in a year, because these prices are only going to go higher, so they're raising their price. Let's look at competition. And this is from Bloomberg, and the link to this is in the description box. I haven't downloaded it yet, the whole report. I didn't need it. There was an article written that cited this chart here. But they have a whole report that you can download for free. So the link to the site where you can download the report for free is there. The reason I didn't download it is Bloomberg is very, very particular about what you can use on anything it produces. I'm using this chart from another site that is citing the Bloomberg report. I want to be careful that I don't cut and paste anything from the Bloomberg report. So I want to get my video up first before I get into it, just so that it was clear that I didn't lift anything from your report. They're very, very particular about that. So I just want to make sure I don't step on anybody's toes here. Let's just revisit the forecast I made, which is what people had pushback on, or those who had pushback. I said they're currently producing 1 million units. For 2022, I gave them the 50% growth that Tesla claims that they'll have. I let them have the 50%. So that gets them to 1.5 million units for 2022. Question mark on that based on the shutdown in Shanghai. Now you may say, well, that was a one-time event. I don't think so. I think that's a recurring event. The Sinovac vaccine doesn't work. That's why they shut down cities. Shanghai is a port city. Ships coming in, people getting off, mingling with the community, people getting back on and heading out to sea. In the fall, when the next wave hits, you don't think Shanghai is going to be shut down again? That's waiting to happen. It's not an event. I think it's going to be just a recurring seasonal thing that happens where you shut down Shanghai every now and then, but it'll happen again. So I had the growth rates I had were 50%, 30%, 20, and 10. Sorry, this is not 2010 over here. Let me just change this quickly here. I think I got confused with the 10%, and this is 2025. So that would take them to 1.5 million units by the end of 2022, 1.95 by the end of 2023, 2.34, and then 2.57 by the end of 2025. Here is Bloomberg's forecast, and Tesla is this the orange bar up here. White bar is Volkswagen. They anticipate Volkswagen by 2024 will overtake Tesla as the leading electric car maker in the world. Here we are in 2021. The way things stand right now, this represents 4.2 million units that were sold that were fully electric. This is all fully electric, 4.2 million units. This over here represents approximately 13 million by 2025. And I put a little white bar at the top for where Tesla is and lined it up with their legend on the side. So by the end of 2022, they have them at 1.4 million units, or a 40% growth. I gave them 50%. They're probably incorporating some effect of the China lockdown on their numbers, perhaps. By the end of 2023, they have them at 1.9, then 2.25, then 2.49 by the end of 2025. So in brackets are the Bloomberg numbers. So I'm more aggressive than Bloomberg on each of the forecasts in terms of volume in here. Their growth rates, I had 50, 30, 20, and 10. They have 40, 36, 18.4, and 10.6. So this is very close to 20. This is very close to 10. Higher than my 30, but lower than my 50 over here. And then you have the growth rate of all the other companies. So I put the growth rate in volumes for all the companies. I calculated some of them. Tesla's growth rate from 2021 all the way to 2025 over these 4 years, they'll grow at 25.61% per year on average, not the 50% that is used in a lot of the forecasts. Now you could say, yeah, but this is just another kind of forecast. Okay, good enough. We'll say that. Volkswagen, 36.7% will grow faster than Tesla, according to Bloomberg. And if you want to look at the assumptions that they made, again, you could download that whole report. GM, 25.7% growth rate, pretty much in line with Tesla's. Ford, 250%. Ford is down here, this little yellow bar down here, and they'll be up here, primarily because of the leaning in on the trucks that they're doing. Mercedes-Benz, 178%. the growth rate for all, excluding Tesla here, the growth rate for all is 35%. So the sum of all will grow at 35% versus Tesla's 25.6%. So Tesla will increase its output by 2.5 times over the next 4 years, but the sum of all will increase their output by 3.3 times. There is growing competition. Competitors are coming in every day. I have my news feed set up so that I get the headlines in every day, and I can pick and choose which ones I want to read. Anything to do with electric vehicles, anything to do with lithium, battery, all that stuff. Every day there's a new announcement somewhere. This model is going electric. Here's an introduction of this model. This new car company, this is doing that. Every single day it's coming in. Now, let me say this. Up to, we'll even say up to 2020. This has been Tesla's market. The electric vehicle market has been their market. They were at it when everyone else was just ignoring it. They faced bankruptcy a couple of times where it looked like they weren't going to make it. And they operated for a long time with negative cash flow before they turned positive cash flow and they turned profitable. This is Tesla's table. They built it. And their lunch is served on this table. This is their table. But everyone's pulling up a chair. Everyone is pulling up a chair. And while no one company right now is eating Tesla's lunch, they're all nibbling. It is not Tesla versus Volkswagen or Tesla versus GM or Tesla versus BYD. It is Tesla versus the sum of all of them. They are all gunning for one player, and that's Tesla, because it's the industry leader right now. Look at where they are in 2021. There they are. So if you're getting into the industry, you don't say, oh my God, I'm going right after Ford. Well, Ford's down here. You say, I'm going to grab that part of the market. This is 4.2 million vehicles, which is about 6% of the volume of cars that were sold in 2021. If the market was not constrained, it would be a bigger market, but it's constrained, so all we can do is look at it that way. And these are all the candidates running for office in this new election. All the candidates running for office. Would you, after 6% of the polling stations report in, would you be ready to call the election? Because that's basically what we have right now. We have a situation where 6% of the polling stations are in, because it's only 6% of the market right now. You have one candidate in the lead, but 94% left up for grabs, and everybody is coming in. That's the threat to this industry. Now, with everyone coming in, industry structure is going to change. So again, all of these competitors coming in are all nibbling at Tesla's plate. Yes, it's their lunch, but it's being eaten. Okay, a few of the headlines that just over the past week. For 2022, in terms of the number of models of EVs there are globally, there's about 450 different EV models, full EV, not hybrid involved in this, full EV globally. BYD is selling so many electric cars, it's become one of the top 3 automakers in China. This was June 13th, 2022. This is just a little extract from that story. Chinese electric car maker BYD saw sales more than double in May, solidifying the company's climb into the ranks of the top 3 automakers in China. Last year, BYD ranked 13th by passenger car sales. For the first 5 months of the year, FAW Volkswagen ranked first by sales, followed by BYD, then Changang Automobile, number 3. Within new energy vehicles, this is EV. This is all types of vehicles. So, of course, we're not going to find Tesla in there. This is all vehicles. New energy vehicles. BYD ranked first, followed by General Motors joint venture with Wuling Motors and state-owned SAIC. Tesla ranked third. This is for the first 5 months of the year. Consumer Reports has a very long article and the link is in the description box below. Automakers are adding electric vehicles to their lineups. Here's what's coming, and it goes on and on and on. The point I'm making here is that it is Tesla versus all of them. And when you have that kind of competition coming in, you don't get to keep your growth rate, and you don't get to keep your margins. The industry will grow as fast as the supply channel will allow it to grow once you hit the wall in 25, 26. The growth of the EV space will be at the speed of the growth of the backstream supply channel growth. But with everybody coming in, you're not going to have the margins that you think you're going to have. And I will do a comparison in this video with Tesla on certain aspects of its, what we'll say, its technology. Okay. You CFA candidates should recognize this from level 1 economics. When we talked about market structure, we talked about industry attractiveness in terms of the type of market structure we have and the type of profitability we would expect to see. We know that in perfect competition, because there are so many sellers selling a pretty much standardized product, that most of them pretty much return their cost to capital. And we start getting into profitability as you move away from perfect competition. Monopolistic competition and oligopoly. This was what the auto industry would have been classified as 20 years ago, an oligopoly. But it is moving more towards monopolistic competition. You're going from a few players to many players. Now, we're not at the many, but we're certainly not at the few. This industry is moving towards monopolistic competition. So we're going to have an industry structure characterized by monopolistic competition. Barriers to entry. It says here, barriers to entry are low versus high. In 1995, if a company came along and said, well, I'm going to start making cars, it pretty much would have been laughed at. It would have been difficult for them to raise any capital at all for a new entrant coming into the market. Would have been very difficult. But in the EV space, because the assembly of the vehicle is far less complex, you're going from what, 34,000 parts down to 10,000 or 11,000. The moving parts go from over 100 to what, less than 10 moving parts in the vehicle. That the barriers to entry on the engineering and production side are very low. And because it's such an attractive industry, there's capital available. So you could say the barriers to entry are low, even though you need big chunks of money. There's a lot of access to that money because there's a lot of euphoria right now for EV makers. And you have new players coming along that never existed before. Technology companies saying, hey, we're going to make a car. So the barriers to entry, while they may seem significant in investment size, are actually low in terms of the access to that investment. That's why I say we're kind of moving away from an oligopolistic situation to monopolistic competition, which is all along here. We do have a low for buyer power. We do have low buyer power because there is no one single big buyer that you have to negotiate with. It's just a whole bunch of consumers. So we'll go through some of these here. Number of sellers. It's not just the number of sellers, it's also the relative size of the sellers as well. As the number of sellers increases, competition clearly increases. The higher the level of competitive rivalry, the lower the industry profitability altogether. That is just part of the industry structure. Porter's 5 forces model talks about the degree of industry rivalry, and specifically that this will be high, meaning industry profitability will be low, when the threat of new entrants or the threat of new models in this case is very high, which it is. Degree of product differentiation. For electric vehicles, it's more so than for ICE. I don't think I've ever bought an ICE vehicle where I've compared the size of engines across vehicles, and I don't think anybody really does that. I think if there are a few motorheads out there that are really into that, but I think the bigger part of the market looks for the design, a design that fits their identity. I pretty much have always had trucks because I like trucks. I don't like cars too much. Other people pick vehicles based on what it looks like, how it feels, the interior, what they see themselves as they're driving that. Once you get into EVs, you're going to have to start paying attention to some things, and I think that there are some characteristics that the EV makers will differentiate themselves on: range, price, charging speed, style. Barriers to entry lower in EV than in ICE, and again that also contributes to the threat of new entrants. And non-price competition, advertising and product differentiation. Tesla doesn't advertise at all, which is one of the reasons their operating margins are so high. But if you have all of these models coming in and all of these competitors coming in, fast forward 2 years from now where it's not number one in its markets, it's not number one in China right now, it's not number one in Europe right now, it's number 3, it's number 1 in the US. But up to now, Tesla has not had to face any real competition in the EV space. Sure, there's competition, but it hasn't had to really fight for its market share. So Tesla is not really battle proven or battle tested at this point in terms of being in the competitive arena. When that does happen, I don't know if they can continue to rely on that advertising. That will have to change. Lower barriers to entry for EV than ICE. High degree of industry rivalry. There's already rumblings of a price war starting on the lower end of the vehicles. All of that is going to lead to margin pressure. You can't escape the gravity of the market structure that you operate in. All you can do to try to get the highest profitability is differentiate yourself as much as you possibly can. And when there's 2,000 models to choose from, not just 500, but 2,000 models to choose from, and 40 different car manufacturers all over the world, and tech companies jumping in, Google, Nvidia, Baidu, Apple, all jumping in. At some point, you're going to have to do some kind of advertising. Now, you could say, well, hang on, he's buying Twitter. That whole platform is advertising. Tesla will have a whole bunch of free advertising. Well, Tesla won't own Twitter. Elon Musk will own Twitter. So maybe Tesla will advertise on Twitter, but I guarantee you Twitter will extract money from Tesla to get that done, because Elon Musk is not going to say, well, I'll give it to you for free, because he'll have more of a vested interest in seeing profitability there, because he'll be one of his share will be much bigger. But this is coming, which isn't in his margins yet. Significantly more competition is coming as the industry moves from oligopoly to monopolistic competition. Okay, let's go to their financials and look at where their margin is going to contract over the next few years. And it's not going to happen, I'm not predicting it's going to happen in the next couple of quarters. I'm sort of looking out to 2025, 2026. When I look at other analysts that have made their projections, they tend to make it with the gross margins that Tesla is listing, without making any adjustments to those gross margins for new expenses coming in and existing sources of revenue that are going to fade away. The most obvious one are the regulatory credits. They've already dropped in 2021 over 2020. I expect them to continue to drop because some of the biggest buyers of their regulatory credits in the past were other auto companies that no longer need them because their EV side has scaled up. And for every EV you make, you get a regulatory credit, which helps offset some of the stuff you're doing on the other side. So the faster car companies shift to EV and the more models they have in EV and the more volume they ship in EV, the less they need to purchase regulatory credits. So that is going away. That will eventually fade to zero. So by 2025, 2026, I have a terminal entry in any forecasting of zero on that line item. For 2021, 1.465 billion came from regulatory credits. There is zero cost of goods associated with this. It is pure margin. In Q1 of last year, 518 518 million came from regulatory credits. Q1 of this year, 679 million. The big amount comes in Q1. I'm not saying that it's going to fade away in 2022 or 2023, but it's going to start drifting downwards, that by the time you get to 2025, 2026, when you hit that wall in the raw material supply, that's when this source of revenue is pretty much going to dry up to zero. So in 2021, Tesla had total gross margins of 25.28% for all of 2021. If you remove the regulatory credit, because I want to see what margin impact it's going to have, so you know what margin impact to take out, they'd be at 23.18%. So for 2021, it was about 2% of total gross margin. And we can see on the exhibit down here, total gross margin is here. This is from Edgar, by the way, if you're wondering where this is from. You can get any company's financial documents on Edgar. Let's look at the first quarter of 2022 here. There's Q1 over Q1 last year. By the way, this regulatory credit thing was an issue with the SEC because they were not breaking them out in their revenue number. They were just putting in the regulatory credit in automotive sales in their top line, and the SEC said, look, these are two different things. One is a tangible product, one is an intangible. You can't group them together. So they did break them out. However, they don't break them out of their margins. They still keep it in their margins. So you look at 32.9 gross margin total automotive. That is fantastic. Ho, ho, ho. Let's remove the effect of the regulatory credit to see what it would be without that, because that is fading away. That is going to go away. This is cost of revenues. This exhibit is just their cost of revenues, and they give all of their margins here. If you go to the the upper part of their income statement, you'll find their revenues are 15,514. Regulatory credits are 679, which brings it to 16,193. Leasing, they have 668, so total revenue of 16,861. And here are their cost, total automotive cost of revenues here. And again, these regulatory credits have zero cost associated with them. They are a residual from producing electric cars. You just get these credits. So if you take the 16,861, you take off the 11,322, you will get to this number over here, 5,539, which they call their gross profit. And then they calculate their gross margin from that. Let's remove the regulatory credit. Our cost, rather than our cost of sales being something like 67%, your cost of sales would be 70%, which means it's like 69 point something, which means your gross margin for total automotive would be somewhere around 30%, not 32.9. So roughly about 3% of gross margin of automotive gross margin is represented by these regulatory credits that will, by 2025, 2026, be worth zero. If you filter it down and look at its total gross profit and total gross margin and adjust that for the regulatory credit, you get to total gross margin of 26.43% instead of 29.1%, which is 2.7% lower. I don't see that accounted for in any forecast. Now, 3% of billions of dollars of revenue end up being something, end up being significant. So you do have to account for that. We'll also see that there's another margin compression of 3% in another place coming up. But this one was sort of an easy one to grab. So this is the note in their statements for automotive regulatory credits. For 2021, the revenue from that category is down 7.6% over 2020. We can see here 1.46 billion versus 1.58 for the year before was 594. So it really increased because their volume really increased. Their volume increased again. Keep that in mind. Their volume increased again, but the revenue from their regulatory credits decreased. We earn tradable credits in the operation of our automotive business under various regulations related to zero-emission vehicles. greenhouse gas, fuel economy, and clean fuel. We sell these credits to other regulated entities who can use the credits to comply with emission standards. Well, if all all the automakers are heading over to EV very quickly, you have a whole bunch of EV startups. You got a lot of regulatory credits out there. The companies that needed the credits are no longer going to need the credits from you because they're generating their own. And even if you argue, well, there are other regulated entities that aren't in the auto business that we can still sell to, so can everyone else. The market will be flooded with regulatory credits. They're not going to be worth what they're worth right now. So 2025, I forecast zero coming from regulatory credits, or if there is anything, it'll be insignificant. So you have to contract their gross margins by about 3%. What's that going to do to EBIT? EBIT will contract by about 3% as well. Q1 2022, if you include the regulatory credits, it had an EBIT margin of 19.12%. If you adjust for the regulatory credit, just to see the impact in the margin, not because it doesn't exist, it existed. So clearly it's to Tesla's benefit, it did exist, but we want to see what margin impact it would have going forward if it were taken out, because we can think it's kind of linear with the number of vehicles that they have produced. Without would have been 16.17%, which EBIT margins will take about a 3% hit, which is consistent with what we've seen on the previous screen. So I think that if you're forecasting out on Tesla right now, by the time you get to, let's say, 2026, your line item there should be zero. And if you were forecasting EBIT based on there being a margin relationship with total sales, you should, at least I think, decrease your EBIT by 3% to account for the loss of that source of revenue. Let's talk about advertising. Most vehicle manufacturers spend a range. There's no one number. Some vehicles get a lot more advertising, some hardly get any advertising. For example, Corvette doesn't feel the need to advertise because it has a base of buyers that will just buy. There are some car manufacturers that also don't feel the need to advertise because they have a very particular product with very particular limited runs, and they're sold out all the time anyways. And then once you get into more mass market vehicles, depending on what target market you're aiming for, you're going to have some kind of revenue. So it ranges right now anywhere from $400 to $1,000 per vehicle. And when you're alone in a space, when it's your space, when there's very little distinction in a buyer's mind between an EV and a Tesla, like there was in 2018, 2019, you don't have to advertise. When you have a lineup out the door, you don't have to advertise. No one, even the majors, have pulled back their advertising this year. They're not advertising as much as they used to advertise, significantly lower in their advertising. And Ford has even gone so far as to say, we're pulling almost all of our advertising. GM has reduced its advertising, but it hasn't pulled it. Ford is from a number of different brands, they're already pulling advertising altogether. So as the industry gets more and more competitors, and there are more and more choices that are all clustered around the same type of features, well, I'll show you in the screens coming up that all of this stuff is tending to cluster in a range, that there is no one significant leader anymore. They're all pretty much in a tight range. To differentiate, you're going to have to get involved in some kind of advertising. So I just said, okay, well, let's start at $100 per vehicle, and we'll bring it up to $500 for Tesla. And then I just picked $300. If the range is $400 to $1,000, I sort of gave it an advantage, saying, well, yeah, it's going to have to advertise, but maybe it'll have to advertise less than anybody else. Operating expense at 100, 200, 300, 400, 500. This is linear because if you're spending 100 per car, it'll scale with the number of cars. So for Q1, 310,000 cars sold, it's 31 million. It's just every $100 would have added 31 million to their operating expense. I'm just trying to get a gauge of what impact it would have on their margins. So if you put them at 300 by 2026 onward, saying, well, look, it's unrealistic to expect that they can continue without advertising when it becomes an extremely crowded marketplace. I think they'd be at a disadvantage by not advertising. If everybody's out there screaming, you better be out there screaming too. It's going to become a competitive necessity. But I still have them on the low end at 300. That's a 2.7% decrease in EBIT. So you have to, in the EBIT margin. So from 2025, 2026 onwards, you're going to have to decrease your margins by 2.7%, only because your operating expense is going to increase. And the percent that I show you is a percent of its is this here, 93 million, represents 2.7% of its existing EBIT. And if you're spending 300 per car, that does scale linearly with your volume. 2.7 here, roughly 3% on the regulatory credits. So if you are forecasting out from 2026 onwards, just the combination of these two is very close to a 6% hit on margins. This here is a result of competitive pressure, but I haven't changed its automotive margins for any competitive pressure as well. The automotive margins on their own are going to shrink. You can only lift your prices so much before you will destroy your own demand. Not right now, because we are in a constrained market. You have to look ahead to 2026. Once the chip shortage abates, the price of those chips are going to be higher. And everyone's going to be in the industry. More and more vehicles are going to be pushed in. This is just 3% from regulatory credits. This is 2.7% from advertising. You think they're going to get zero margin compression on their automotive margins from competition? Come on. You can probably put another 5 to 6% in there. So if you have 5 to 6% over there, and you've got roughly 5.5 to 6% over here, you got somewhere between 11.5 and 12% margin compression that you should be modeling 2026 going forward. All right, let's have a look at their basic versus diluted earnings per share. Basic seems to get all the headlines, and valuation seems to be based on basic. And I'm going to make the argument that given the spread between basic and diluted, you really have to be looking at diluted, because that unfortunately is the long-term truth. If you're forecasting out long-term, you should be basing your valuation on the diluted earnings per share, not the basic earnings per share. So there are two statements you can make about the dilution. Dilution could be ending soon, or it could be continuing. If it is going to continue, you have to use diluted earnings per share times the forward multiple, because in a couple of years, the share count is going to increase and dilute you anyways. And if you are looking at a multiple of earnings, you have to consider the amount of dilution in the shares that are going to happen by 2026, 2027, 2030. You can't just use a growing EPS without having a growing share count at the same time. So I see forecasts done this way, where revenues, cost of goods sold, all the way down. Here's my EPS times my multiple, and this is 2030. There's my EPS times my multiple. There we go. Well, this EPS is based on a share count, and I don't see an increase in the share count in some of these forecasts. So right away, I got a problem with that, saying, well, you're not even accounting for the dilution over time. Let's have a look at this. By the way, if it is ending soon, that does bring up the question is, are you going to have a competition for talent? Because you hear the argument that Tesla has the best engineers. Is that because of the option-based compensation? And if that is going to disappear, if it's going to become less and less a percent of their expenses, and that's going to slowly go away, are they going to face increased competition for that quote-unquote best engineering talent? Here is 2019, 2020, 2021 basic and diluted, and here is the share count they have for basic and diluted. The basic share count has increased from 2019 to 2020 by 5.1%. Then from 2020 to 2021 increased another 5.7%. Well, I don't see that. When I look at forecasts, I don't see a share count increasing over time. which to me seems like a glaring mistake. The increase for diluted, the increase in the share count, 22% from 2019 to 2020, increased another 4.2% into 2021. So you could make the argument, well, yeah, it's going to end soon. The effect of it is going to end soon because it is decreasing over time. If we look at just Q1 2021 versus Q1 2022, the basic share count increased 7.6% year over year, while the diluted share count only increased 2.1%. So you might be able to make that argument that, yeah, it's ending soon, but I'm kind of skeptical when I see these things. I think, well, I'm going to continue to forecast this out. I'm going to forecast something for the share count. I'm not just going to lock the share count to 2022 and just have this ever increasing EPS divided by the current share count. You have to forecast out your share count over time as well to get your earnings per share. If you're pricing it on some multiple of earnings, those earnings have to be earnings per share. You can't have 2030 earnings divided by 2022 share count. You get where I'm going with that? For 2022, this is from 32 analysts. The number in brackets is the number of analysts. This is the average earnings per share based on 32 analysts. And I'm sure that earnings per share is based on the current number of shares outstanding. Well, by the end of this year, the diluted, some of the options may be exercised. The basic count may actually be higher, but 1211. If we assume 90%, this is right here, diluted represents 87.5% of basic. Here for Q1, diluted represents almost 90% of basic earnings. So I'm saying, well, okay, if it's 1211, multiply it by the 0.9, because you really should be using the diluted EPS for valuation, because valuation is a forward-looking thing. So is diluted earnings per share a forward-looking thing, because it's forecasting what your dilution is going to be on your share count. So you should be using diluted earnings per share. This is, you get to 1090 on a diluted earnings per share with a 40 multiple is $436 by the end of 2022. In my video, last video, I said 418, or I did a quick back of the envelope calculation with some just big assumptions, and I got to 418. Here you get to 436. This again is basing it on these 32 analysts. This 1211 is not mine. This is the average of these 32 analysts. Yes, there's dispersion in there, but usually wisdom of the crowds, right? That if you have a jar of jelly beans and 50 people guess how many jelly beans are in the jar, the average is usually the closest estimate. So that's not mine. This, I'm just saying, look, based on 90% here, you have to use the diluted EPS. For fiscal 2023, based on 30 analysts, they're at $15.95. Again, assuming that diluted represents 90% of basic, you get to $14.35 on a diluted basis. And there I'm saying you'll probably be closer to 30 times earnings. I don't know. What I'm saying with the 40 to the 30 downwards is that their forward multiple is going to contract going forward. I just say, yeah, 30 sounds like a reasonable number because it's less than 40, but it's not 15. You get to $430 by the end of 2023. I'm at $339. You could make the argument that this is just, all companies have this, but when we look at other car companies, GM, their diluted earnings per share is 99.26% of their basic. It's almost the same number. It's off by a penny. For Ford, their diluted earnings per share is 98.8% of their basic earnings, not 90%. And the yeah-butters come in and say, yeah, but Tesla is a tech company. Okay, well, Apple, the basic earnings diluted is 98.7% of basic. Netflix is 98% of basic. Tesla is 90% of basic. That tells me something about the share count going forward. You have to use a forward share count if you're using a forward multiple, especially if you're forecasting out to 2030 and you're using some multiple to come up with a a value at 2030, which you're going to discount back today. You know how that works. You have a period of discounted cash flows, an explicit period of forecast, followed by some terminal value in 2030. Well, I see that terminal value as the earnings per share multiplied by the current share count to get to the earnings divided by the share count today to get to EPS, not what a 2030 share count will be. That's why I'm saying you have to use diluted if you're going to forecast out, and you have to forecast out the continued dilution in the share count as well. Okay, let's look at some effects on Q2 of 2022. This is nothing on a going forward basis. These are probably just events. The Bitcoin one, the deferred revenue, you got to put a bit of a question mark in here. There might be a problem here. But note number 3 for digital assets. How Bitcoin works on financial statements is you list it on the balance sheet at your cost. And if Bitcoin increases, you cannot list it at a higher price. You can't send anything through OCI either, but you can, in a note, state what the fair market value of your holdings are. You can do that. However, if it drops, you must take an impairment. So Bitcoin dropped, and Tesla is going to have to take an impairment. So if Bitcoin stays in around 21.5, it's got till June 30th, 0630. To see if it recovers, because it has to the end of the quarter to see if it recovers. But if it stays at around 21.5, you've got an impairment charge of 360 million coming, and they don't break it out on a separate line item. It's in one of the line items, so you are going to have to go to note 3 to find the answer to it. So they can tell you what the fair market value of the assets were. They had it listed at digital assets held 1.26 billion because they've already had some sales and they already had some impairments, cumulative impairments of 101. They have it listed at 1.26, but they can tell you what the fair value was, 1.96 billion as of March 21st, 2022. It is not 1.96 billion anymore. If you're looking at roughly about a $360 million hit, you're bringing it down to about 900 million. There's a $1 billion hit in fair value. However, they couldn't list the gain anywhere, so it's not as if it's in the EP that was in the EPS numbers. It couldn't be. It might have been in the valuation model of some analysts saying, aha, that's there. Well, you got a charge coming. This is an income statement charge. That is going to happen, which is going to be a hit to Q2 EPS. We are all aware of how high multiple companies have been absolutely punished this year when they miss EPS. If their growth rates suffer a bit, if their subscriber count suffers a bit, if their earnings per share suffers a bit, if their margins suffer a bit, we have seen almost no forgiveness. Sometimes stocks cut in half because they miss on something. Tesla has a high multiple company, and I'm absolutely certain that they are aware of this, and that they certainly want to try to do everything they can to avoid a quarter which is questionable to investors, because even taking 5 or 6 times off their multiple can drop the share price quite significantly. Never mind being cut in half. Never mind the multiple going down to something like 30 right away. You try to avoid that as much as you can. Well, you can. You do have a Q2 offset from deferred revenue from full self-driving. If you push more of these updates out, you can recognize some of that revenue. Rules for revenue recognition changed a few years back. When you sell a tangible product, like a car or a computer, and it has an intangible associated with it like software, you cannot recognize 100% of the sale on the day that you make it. Apple has this issue as well. When it sells a computer, because it gives you updates for as long as you own it, the thinking is, well, when you sell the computer, you haven't delivered 100% of the product because these updates are in the cost of what you're doing. So you're going to have some kind of unearned revenue that you recognize over time as you deliver these updates. Well, it's the same with the car. FSD was sold as a $12,000 add-on. So the more people that actually have it delivered, the more revenue they can recognize. However, to have it delivered, you needed a safety score of 98. Once you achieved a safety score of 98, you could download it and they could then recognize the revenue on that. So let's follow the money. Elon Musk is saying that Tesla will start releasing the FSD beta to drivers with a safety score of 98 or higher. If you're trying to reach a score of 98, you can use our safety score calculator to see how many more miles you need to drive. And in time, Tesla is getting ready to expand the FSD beta to owners with a safety score of 95. And in the second quarter of this year, after the Shanghai lockdown, we had this. Tesla finally lowers FSD beta safety score requirement to 91 with a question mark. So he went from 98, and you can download it, to let's go to 95, and let's see how many more people we can get in to unlock some of this unearned revenue. Let's just drop it to 91, okay? China's going to hurt us, and this is before Bitcoin took a real dump. China's going to hurt us. Let's go down to here. Let's see how much money this unlocks, by the way. All right, Tesla has unlocked substantial deferred revenue recognition by expanding its FSD beta to 100,000 additional users. If you have a safety score of 95, go ahead and download it. Sir, we're still not at 100,000. Well, then lower it to 91. How's that? Now that Tesla is expanding its FSD beta to 100,000 new users, a significant chunk of this deferred revenue stands to be recognized, boosting the prospects for the EV giant's upcoming Q2 2022 earnings. Conservatively speaking, Tesla might feasibly recognize around 300 million of deferred revenue, based on the assumption that it would recognize at least 3,000 from each eligible FSD-enabled customer. 300 million. To help offset what was going on in Shanghai. How do you get to 100,000? Can't get it with 98, do it with 95. Can't get it with 95, drop the safety score to 91. How's that sound? Now, you may push back and say, whoa, yeah, sure, this is going on, but FSD is almost ready. Level 4, here we come. He's doing that, lowering it to 91 because it's so good. You don't need a safety score of 98 anymore. You only need a safety score of 91. There is a description box. In the description box, I have a video. This is the link to the video itself, but there's a video. And this is it. This is Elon Musk talking about FSD and robotaxis himself. I just came across this video. It was in one of the stories. I came across the video and I watched it because I can remember. It's not like I just first heard of Tesla a year ago. I can remember him talking about this a long time ago. Elon Musk promising Tesla robotaxis for next year for almost a decade, and it starts at 2014. And in this interview, he says, yeah, I think we can have that by the end of the year. 2015, yeah, I think we'll have that out this year. 2016, oh, I can see it happening by mid next year. Every single year, he says the same thing. He says the same thing. Level 4 is coming, fleet of robo-taxis, all of that stuff. 2020, yeah, we're getting into lithium mining. It's going to be great. 2022, I swear to God, we're getting into lithium mining. It's going to be great. We have a process that no one's ever seen before. When 3-4 years ago, no one ever questioned anything he said. It was, the market just responded. But more and more, I'm seeing in the news feed that I get that there's just pushback on things he's saying. Well, sure, he says this, but he says a lot of things, and when it's being openly, when you can openly find this. I'm not a big fan of the video overall. I think it's, I think somebody had an axe to grind on that one. I'm not a big fan of it, but you can't escape the fact that he himself is the one that's saying it each year. Now, let's not leave the 91 safety score behind just yet. This is from June 15th, you know, at some point I had to do this video. Every day I wake up, there's new information in my feed that go, oh, well, I can use this, or I should say something about that, or I should do this. But at some point you got to cut it off. There's so much more information out there. Elon Musk says solving self-driving is the difference between Tesla being worth a lot or Tesla being worth nothing. This article, the link is in the description box again, and within this article is the video, and it's cued to the time where he does start saying that. So all you have to do is press play, and he is discussing FSD, and he is fully acknowledging that if we don't get it, we're worth nothing. And it's not hyperbole. I think he's right. Not that Tesla will be worth nothing. The first company to FSD will have a competitive advantage, but it won't be a sustainable competitive advantage because everybody's working towards FSD. However, not having it would be competitive suicide. So I don't think that he's wrong in saying it's the difference between it being worth, I wouldn't say a lot, worth something, because it'll be worth something or nothing. FSD is a hole that Tesla has to crawl itself out of because it has been selling it to customers with promises. If it doesn't deliver on those promises or keeps delaying them, there's going to be a reckoning, and it could be a costly one for Tesla. And again, you can look at that interview. Let's look at that 91 safety score. Lowering FSD all the way to 91, and that we're super close to level 4, or the belief is that it's so good they're close to level 4. Well, you can't escape this. You know, if you just look at their autopilot issue, this is level 2, by the way. This is just a level 2 issue. I don't see them getting anything on level 4 while this is outstanding. I don't see it happening. You know, you don't have to go through the levels. You don't have to go level 1, 2, 3, 4, 5. You can introduce a vehicle at level 5 if you have one, but you have to be get it through the regulators in that country that you are at that level. I don't see L4 happening with this overhanging their head. The National Highway and Transportation Safety Association upgrades Tesla investigation into emergency vehicle crashes, inches closer to a recall, probing the autopilot software. 830,000 Teslas with autopilot, a recall possible. As far as recalls go, listen, that's just the nature of being in the industry. You're going to have recalls. Every single car company in existence today has had a recall, and every single car company in existence in 2040 will have a recall sometime in the next 20 years. It's just part of being in the industry. I'm not putting this up because, aha, look, there's a recall. I'm putting this up to make the point that you got your level 2 autopilot under investigation. You have to deliver on FSD because you've sold it. You've lowered your score down to 91 while you have this thing going on. It does unlock a lot of deferred revenue. I'm having a hard time believing that it is so good and you're so close to getting it done, because if you were so close, you would have already had a solution for this problem. So in case you're not sure what all the levels are, here they are down here. Level 0, no automation. Every vehicle by default is a level 0. Level 1, driver assistance. GM has had this for a while on its higher end vehicles. So take, not even its higher end vehicles, but on quite a few of them. I've had a Corvette, I've had the Avalanche. It's one of two things. Driver can delegate either steering or accelerating and braking to the system. And it's the accelerating or braking that I can remember being on one vehicle I had. Level 2, partial automation. That's where Tesla is. That's what autopilot is. The driver must permanently monitor the system. Level 3 is conditional automation. Mercedes has level 3. Mercedes beats Tesla, the hands-free driving on highways. It's the only one, sorry, not the only one. It beat Tesla to a level 3. But to be fair, I don't think Tesla's even aiming for level 3. I think it's aiming right for level 4, so I don't think it really cares too much about that. Level 4 is high automation. The driver can transfer complete control to the system and devote himself to other activities. However, he can take control at any time he wants. And then level 5 is no driver needed in the vehicle at all. Top cars with autopilot features for 2022. Tesla, GM, it's got the Cadillac, the Escalade, Chevy Bolt, the Hummer, Audi, BMW, Ford, Lincoln, Kia. Kia is working on level 4 right now in South Korea in the Gangnam district, and apparently it's very, very advanced. Mercedes-Benz, Volvo, Nissan, Infiniti. Do you get the point here? Tesla's not alone. Not having it is going to be a competitive disadvantage. Having it may or may not be a competitive advantage. Getting it first may be a competitive advantage, but it's not going to be a sustainable competitive advantage because every car will eventually have it. Every car will eventually have it. Not having it is the problem. So I think Elon Musk was right when he said FSD is the difference between Tesla being worth something or being worth nothing. I think the worth nothing is right. If you don't get it, if you can't solve that problem, that's a problem. 40 plus corporations working on autonomous vehicles. Beyond trendy names like Tesla and Alphabet chasing self-driving cars, a host of auto brands and other tech heavyweights are also investing in autonomous R&D. So this got me thinking, who are these people? Let's have a look. Okay, this is a small excerpt from a research report that you can buy for $3,600. In case you're thinking $3,600 is ridiculous, look what they did. The market research firm performed an analysis of the entire emerging autonomous driving industry. So let's just leave it there for a second. Now imagine that you were going to invest in that space. You're a large fund and you're going to invest in that space. Well, you need to know who to invest in. So you hire a couple of analysts and you give them 4 months to get the job done. It's going to cost you a hell of a lot more than $3,600 to do that. If you don't have in-house expertise, you pay for the research. You got to think, well, what would it cost me to get it done in-house? If you think $3,600 is too much, try hiring analysts to get that done. You'll spend a lot more than $3,600. Now, because it is sold for $3,600, you cannot have an axe to grind because you'll get called out on that right away. If I'm spending $3,600 and I see that this is nothing more than a hit piece, I want my money back. This is not honest research. So I tend to believe, or I have more faith in outcomes there. But this is damning. Forget Tesla. Experts say these 4 tech companies are the future of self-driving cars. We were promised self-driving cars before the end of the last decade, and those predictions turned out to be wildly, hilariously wrong. But things may be catching up, and the loser of the pack, according to Sam Abul-Samid of Guidehouse Insights, is Tesla, the loser of the pack, which may surprise droves of Elon stans. The market research firm performed an analysis of the entire emerging autonomous driving industry, and the company wasn't just last in the just released annual scorecard. It was by miles and miles. And this is a quote from him. Of course, there's also the elephant in the room that is Tesla. To be honest, I'm not sure they really belong in this group at all, but the company and CEO have been so insistent that they are developing full self-driving, and they get most of the attention from the media and the financial markets that I felt they should be here just to demonstrate where they actually stand. And this is in terms of their ability to execute, and this is in terms of their strategy. There's Tesla. In one of the follower categories, you have challengers, contenders, and leaders. Look who's up here: Waymo, Nvidia, Baidu, Argo, Cruise. By the way, Cruise, that's GM. Do you know who the other owner is of Cruise? Microsoft. So you've got Alphabet up here, Baidu, Nvidia. You've got Microsoft up here. These are not nobodies. Apple is in there as well. I forget which one Apple has, but Apple is backing one of these. These are not nobodies. Microsoft, Google, Baidu, Apple. These are companies with deep history in technology. Intel is in here as well. Again, these are not nobodies. When we say, oh, but Tesla has the best engineers, do they? Better than Apple? Better than Intel? Better than Nvidia? Better than all of those? Come on. So they're not alone. So the forecasts I see of FSD and all of the revenue generated by FSD assumes that they're going to have some kind of near monopoly on it, that they're so far advanced, they're so far ahead of the pack. And I've not found, other than publications which are really centered around Tesla fandom, I've not found anything that points to Tesla being so far ahead of everyone else that it's unbelievable and no one can ever catch up. That's not in the forecasts. As far as this idea that Tesla has of all of these robo-taxis, that once you get to FSD, there'll be this fleet of robo-taxis and everybody can make money off of their car, and the sharing community is just going to increase dramatically. These are not houses. You can list your house on any of the rental sites, and you can get rentals in your house. And it's not, who is in your house is not going to affect your insurance rates, but who is in your car is going to. The moment you call your insurance company and say, yeah, I'm going to let my car drive around, oh, whoa, 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 commercial? Let me transfer you to that department. And if you want to know what your insurance rates are going to be, call your insurance company and say, I'm thinking of doing this with my vehicle. What are my insurance rates going to be? And sit down. The other thing is, you just paid $70,000 for this car that has this self-driving feature, and you're going to send it out there and let strangers enter your car. It's going to come back to you with coffee stains. It's going to smell like cigarettes because, of course, people are going to smoke in it. It's going to smell like a whole bunch of other things, or maybe puke in the back seat. Ask any cab driver how long he spends at the end of every shift cleaning his car. That's why when you sit in the back of a cab, you're sitting on plastic seats. It's just a vinyl seat. That's all it is, a cheap vinyl seat, because they take the really expensive seats out and they put the cheap seats in. You're going to let your $70,000 vehicle drive around town picking up people. It's going to come back with coffee cups, coffee stains, paper bags, half-eaten lunches, mayonnaise stains, scuffs on the dashboard, puke in the back seat. Maybe somebody pissed themselves in your front seat. The smell of cigarette smoke. You're really going to do that? And you're going to pay those insurance rates? The other problem with robotaxi, and I don't see this anywhere, it doesn't take gas. Then you maybe think, yeah, that's the point. It takes no gas. Well, when you fill up with gas, there is a road tax in the gas, so that those who use the road a lot, the thinking goes, will use more gas, and they'll pay a larger share of the road tax because they're using the road a lot. Electric vehicles don't use gas. They don't pay any road tax even though they're using the road. And you want to run a fleet of these, or even just your own, or let's just imagine a city with a fleet of them, a whole army of these driving around, and the municipality is going to say, yeah, that's okay. Don't worry about the road tax. It's on us. You go ahead and enjoy yourself. These will be regulated and taxed faster than you can imagine. There will be a road tax associated with having a license to operate one of these. Your insurance rates are going to increase dramatically. You're going to reduce your battery life because it only has so many cycles. You got maybe 1,000 to 1,500 cycles, which should last you normally 10 to 12 years. You're going to wear that battery down in about 3.5 years, and you're going to have to replace that. You're going to spend half an hour every day cleaning your vehicle. Do you really think that sounds like a future that's going to happen? Absolutely not. So all of this idea of all these people independently putting their cars out on the road to generate revenue is not going to happen. I see cab fleets getting into the business. I see more commercial entities getting into the business. Large enough companies that have the wherewithal to understand how that industry works and to operate in that industry. But to buy a $70,000 vehicle and send it out on the road, you'll do that twice. The moment you get in your vehicle and you got to clean up a coffee stain and you smell cigarettes, that'll be the end of that. The moment you find out how much it's going to cost for insurance, that'll be the end of that. So no, all of those great forecasts with all of these trillions of dollars, Kathy Wood saying, oh, it's going to be a $12 trillion industry by 2030, robotaxis. No, it's not. Anyways, I've gone about as far as I care to go. I think I've made my point. Tesla is not as far advanced as everybody thinks it is. It only just gets a lot of press. There are dozens of companies working on autonomous vehicles right now. There are dozens of companies working on battery chemistry. That Tesla's new battery has some good potential, but it is nowhere near what it's being claimed. Just so that we can understand the benchmark that everybody's trying to reach. For mass market adoption, there are three numbers: 30,000, 300, and 30. A vehicle that sells under 300,000. Under 30,000, that has a range of 300 miles or more and can charge in 30 minutes or less. Tesla has none of this with their new battery. Their new battery, you can charge from 9% to 80% in 34 minutes. That's not under 30 minutes for a full charge. To get to 97% takes 50 minutes. And the range on the new vehicle they put it in is 259 miles. But in their defense, it is a 50 kilowatt battery, not a 65. It is a 50 on that one. And the car starts at 59.9. Now they say, well, you can opt for the larger battery to get a longer range. But then this charging time increases dramatically. To get the charging time down to where to 34 minutes, 9% to 80%, 34 minutes, which is not bad. It's not great. It's not bad. It's not the middle of the distribution. It's in the upper end of the distribution, but it's not great. It's not bad. To get the range higher, this would increase as well, and the cost would increase. So they're nowhere near this category, but they may not be trying to compete in that category. They have been promising for quite some time a $25,000 vehicle, saying that they're eventually going to have that magic vehicle down there at $25,000. But that new battery that they have is good, but it's not great. And there are literally dozens of companies working on battery technology. It's not going to be a kingmaker. Range, battery size, battery chemistry is not going to be a kingmaker. Everyone is going to have it, and that distribution in terms of what batteries can do and what self-driving can do, that distribution will shrink, and everyone will end up in a very tight place. Not having it will destroy you, but having it, I don't think, is going to be very much. Before I go, we'll talk about the truck here. Just so that we know where we stand here so far. Tesla was beat to level 3 by Mercedes. They will likely be beat to level 4. They will most likely be beat to level 4. I don't see them being the first at level 4. I see them trailing by quite a bit. They were beat in first to Robotaxi. They were beat in first to truck. And they did announce the truck is coming. It's coming very soon, fall of 2023, so a whole year away. So that big plant they have in Texas, a big part of it is lying idle because it was meant for the truck. So even though the plant has a capacity to produce vehicles, it's not producing any vehicles right now. The thinking is that by the time this truck is introduced to the market, 6 other pickup trucks will have already been introduced. Let me just read to you something here. The Tesla Cybertruck is falling behind. A handful of automakers have beaten Elon Musk's Tesla to the EV pickup punch. On Twitter, Musk responded with the comment, "Cybertruck body," as well as a video of Idra's Neo 9000 Gigapress being assembled in Italy. There is a cool video on YouTube of this press. As an engineering feat, it is amazing. It's super big. And in a response to a video of the Cybertruck prototype in California, he wrote, "It will be our best product ever, IMO," which means in my opinion. This is in a a story. It goes on. The writer of the story goes on, and I see this more and more of Elon Musk just being called out for saying stuff. Tesla being Tesla and Musk being Musk, it's hard to take words at face value. We still haven't really seen any sort of Cybertruck concept that even sort of resembles something that would pass DOT standards. But hey, only time will tell. The fanboys will just have to keep watching people show off their R1Ts. That's Rivian's truck. Rivian beat them. The startup, Rivian beat them to a truck. Ford beat them to a truck. And my prediction is GM will beat them to a truck as well. And there'll be others that beat them to a truck. And by the time they get it out, the truck will already be out there. Their product cycles are slower. The rest of the industry is moving faster. One of the benefits the rest of the industry has is that Tesla built out the supply channel. Tesla built out a whole bunch of that stuff from scratch. Take your hat off to them. They did it. They built it up. They built that whole freeway. But they also built a whole bunch of the on-ramps. Everyone doesn't have to start at the beginning of the freeway. They can just get on right where Tesla is right now, and everybody is on-ramping. Everybody is on-ramping. Everyone is pulling up a chair to Tesla's table, and they're all nibbling at Tesla's lunch. And there it is. So, yeah. If you have any other follow-on comments, any more yeah buts that I didn't get to, the comment box is below. But I'm probably not going to do another follow-up video to this one. Lots of resources in the description box. You can go to the sources yourself and have a look. And then, yeah, we'll just let time tell, what happens.